In this video, we discuss about the conditions under which binomial distribution can be applied. One very important condition while applying binomial distribution is that there should be only two mutually exclusive outcomes. So if we are tossing a coin, you can get either a head or a tail. Here, if you are getting a head, then you are not getting a tail. So the two outcomes are mutually exclusive. If there is an insurance policy, then in that either claim will happen or there will not be any claim. Again, you have two mutually exclusive outcomes. If you are throwing a die, there are 6 possible outcomes. You can get 1, 2, 3, 4, 5 or 6. But if we are interested in knowing the probability of getting certain number of 5s out of certain number of throws of die, then in a throw either we will be getting a 5 or we will not be getting a 5. So that again becomes two mutually exclusive outcomes. The second very important criteria while deciding whether binomial distribution can be applied or not is that outcomes in different trials should be mutually independent. So when we toss a coin and whatever output we get, whether it is head or tail, when you toss the same coin again, then the outcome of getting a head or a tail will not depend on the previous outcome. So if there is an insurance business where there are 100 different policies issued, then the claim happening in one policy should not be dependent on the claim happening in other policies. If the outcomes are mutually dependent, then binomial distribution will not be applicable there. Here we see how we can find the probability of 20 death claims from 500 life insurance policies. For this, suppose the probability of death claim happening is denoted by P, then probability that death claim doesn't happen, that will be 1 minus P, because there are only two possibilities. Now, whenever death claim happens, the probability of that is P. So since 20 death claims are happening in 500 life insurance policies, so whenever death claim is happening, we take P as the probability and we keep on multiplying that. Since there are 20 death claims, so this will be happening 20 times. Now remaining 480 times, death claim not happening. So 1 minus P will be getting multiplied 480 times. Now, out of these 500 insurance policies, this 20 policies where death claim happens, that can happen in 500 C20 wage. So, the probability that we get exactly 20 death claims out of 500 life insurance policies will be actually product of these three. So probability of getting exactly 20 death claims from 500 life insurance policies will be 500 C20, that is the number of wage in which 20 insurance policies can be taken out of 500 policies where death claim happens, multiplied by P raised to the power 20, that is 20 times death claims happening, multiplied by 1 minus P, which is the probability of no death claim. This has to be raised to the power 500 minus 20, that is 480. This is the binomial distribution, and this gives us the probability of 20 death claims from 500 life insurance policies.